Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we are tracking for you in the BNN Bloomberg newsroom. Lululemon founder Chip Wilson is pushing for a board shakeup while Lululemon searches for a new chief executive. Earlier this month, the company announced CEO Calvin McDonald would be stepping down come January. Wilson has nominated 3 candidates to Lululemon's board, including former On Running co-CEO Mark Morer and former ESPN Chief Marketing Officer Laura Gentili and former Activision CEO Eric Hirshberg. The United States is offering Ukraine security guarantees for a period of 15 years as part of a proposed peace plan, Ukrainian President Volodymyr Zelensky said on Monday. And despite the offer, the Ukrainian president has said he would prefer an American commitment of up to 50 years to deter Russia from further attempts to seize its neighbor's land by force. SoftBank Group has agreed to acquire Digital Bridge Group, a U.S.-listed investment firm focused on digital infrastructure, including data centers. The Japanese conglomerate will pay $16 U.S. per share in cash for Digital Bridge. The acquisition is part of SoftBank's push to invest in the digital infrastructure fueling the artificial intelligence boom. Shares of NVIDIA are down after the AI chip designer purchased Intel shares worth $5 billion U.S., carrying out a transaction announced in September. The deal is seen as a major financial lifeline for Intel after years of missteps and capital-intensive production capacity expansions drained its finances. Silver, one of the biggest movers of the year, just staged a massive reversal, sliding today after topping $80 an ounce for the first time ever in overnight trading. You can see it's down 7.7% right now and only going lower. Let's talk more about this and the markets in general. Let's bring in Jeff Hull, Senior Financial Advisor with Manulife Wealth. Jeff, thanks as always for joining us. All the best for the holidays. Hope you had a nice break. Well, you're in the middle of the break. But thank you for coming in and joining us.
In the financial world, there is no break.
There is no, and if the changes come down to the markets, it'll be almost 24/7, right?
You got it.
Trading.
Yeah.
Okay, silver first, because I was off Christmas Eve and then the rest of the weekend. So I left Tuesday, and I think it was like $64 an ounce. And I came back in this morning going, what happened? What went on?
Well, it's interesting. North American, European markets, a lot were closed for Christmas. Shanghai's market on commodities was not closed. And there's been this kind of an anomaly that's happened with silver. So as an example, it's had a nice run this year, as has gold.
Yep.
But there's been a
better run than gold, right?
Yeah, better run than gold, actually. But silver's kind of the poor man's gold, they call it, right?
Yeah.
But silver's really used a lot in industrial things. It's used in everything from AI data centers. It's used in aerospace. It's used in electric vehicles. And a couple things have happened all at the same time. One is Samsung has developed a new EV battery that could charge as little as 9 minutes and go almost twice as far as Tesla's batteries potentially. So that's a big thing that will need a lot of silver because that's the main ingredient in their new battery technology. But simultaneously, China is building out its AI data centers in massive solar farm arrays. And those solar farms, those panels need
huge users.
Silver as well. So as of Thursday, January 1st, China's put in not a total ban, but a complete restriction on all silver exports leaving China. Well, that's only about 10% of global supply, but Hong Kong's about another 9-10. That's about 20% of global supply. That's kind of, it's not moving around the world anymore. So now people are getting a little bit nervous. So hence why silver's had a bit of a run. We'll see how this pans out, but it's a really interesting area for investors to keep an eye on.
What do you do with it? And was it Samsung that just bought the rights to silver from a mine in Peru?
Yeah, everybody's kind of clamoring for mines. The problem is you got this supply and demand change. You can't get Santa Elves starting to dig for more silver all of a sudden. You have to start ripping it out of the ground. It takes time. And it takes permits in different countries and export restrictions. So
10 years, right? 10 years to from the concept to actually getting silver out of the ground?
Absolutely. It depends on the country and whether there's a puppet government or not. That also influences. But the big thing investors need to watch out for, and this is something that harkens back to 2008 that does worry me about gold, silver, and other commodities, is a lot of ETFs and things that claim to own silver bullion or gold may not control or own the actual direct silver, the physical asset. They may just have a paper promise that they bought from somebody else, that they've sold another paper promise to the next person. Now you get this kind of paper domino effect where what investors really need to focus on is the actual metal. If you're going to buy a fund or something like that, do they own and control in their vault or hire a vault with serial numbers to their own silver so you know that they own it? You don't want this parade of paper promises that could end up nowhere. So people need to be very careful. In my estimation, just like I called the 2008 Great Recession with the credit default swaps, I see a similar thing with gold and silver now, where there's more paper promises associated to gold and silver than there is gold and silver. So somewhere in there, something's gone astray. So investors just need to be careful in that area. Interesting area, but be careful.
And where's it shaping up with prices and that? Does it look like it's going to, I mean, silver is volatile. Is it going to, does it look like 2026 is going to kind of maintain this direction that it's heading?
The demand is there, but there's a lot of influences from government and other factors that could press on that as well. So it's had an incredible run. Could it continue? It could, but investors, again, have to be very careful. But the key, as I mentioned earlier, you got to own that physical asset or something that does own it. Try to avoid the paper promises.
Okay, let's talk about S&P, TSX. Good years all around, and everybody's like, is it going to be the same for next year? Is it sell, sell, sell? What kind of year do they have, and what kind of year are they looking at?
Well, it depends on the investor's own investments, but we do like what we see in 2026. There's a couple of big factors coming up. The biggest one next year that will influence a lot of what happens, especially on North American markets, will be the midterm elections in the U.S. in November. Most politicians obviously dole out the bitter medicine at the beginning of their presidency, example, just like Trump's done. Everyone's elbow is up. He's bruising and breaking relationships because he had about 6 months to do 6 years worth of change. And as they draw closer to that election, a lot of candy is going to get handed out to everybody, and everyone's going to look a little bit better. I hope, and likely will happen, but not too much, will be the politicians on both sides in the U.S. will be a little bit more behaved as they get closer to the election. They don't want to look like a complete buffoon. And Trump needs the Republicans to to hold the House.
Well, yeah, it's close for them, right?
Yeah, well, if they don't, what happens to Trump in his last 2 years? The Democrats will just zip up the purse strings of the House of Representatives. There'll be no money coming to the government. It's going to be impeach, impeach, impeach every day. And he won't be able to go down as one of the best presidents, at least in his own mind, because the last 2 years have been kind of neutered and can't do much. So he's got to win that. So he's got to look good. He's got to make sure oil's down, inflation's down, stock market up, business doing well, taxes lower, and everyone with a little more walking around money in their jeans feeling a little wealthier if he even has a chance. Because historically, usually the other party in the midterms usually does take the House back. But we'll have to see. But that's going to be one of the biggest influences on the markets overall in 2026.
And Canada as well, influencing Canada as well?
Yeah, Canada unfortunately has a tough job with Trump. Trump's using Canada as a punching bag for the next 3 years. So we're hoping cooler heads will prevail. But Canada may be one of the last trade deals he ultimately does.
Do you see, if they lose the House, would that change anything on how he approaches Canada?
It could, actually. There could be some better deals possibly made. But again, we'll have to wait and see for the actual result. But there is one more thing that I think will really influence 2026, and it's space, the final frontier. Elon Musk has announced he will be doing a SpaceX IPO coming up in 2026. You know, everyone would be very desirous to get this. This could be the biggest IPO in history, as high as maybe 1.5 trillion. That's bigger than Saudi Aramco's was a number of years ago, which is the state-owned oil company out of Saudi Arabia. And a lot of people will be desirous to get those shares, but won't be able to. So they'll start to look at competitors in the space area to also invest. So that would be another interesting area for investors to keep an eye on as well.
Okay, and one other thing you had in your notes, just want to talk about, you actually think that we're actually might get into the Ring of Fire?
I think
in Ontario?
Yeah,
I mean, this is something that's been going on for, I think, 25 years. I can remember them talking about the Ring of Fire, and we haven't done anything.
They've done literally almost nothing. But what's interesting is Doug Ford and Carney are getting along fairly well, and it looks like some things for the first time I've seen more movement on that in the last 3 months than I have in the last 3 years. So I think that could add some interesting capabilities. Prime Minister Carney needs to get Canada some wins on Canadian soil, and provinces start to have to behave with each other, do trade with each other. We have all these international trade deals around the world for Canada. It's silly we don't have interprovincial deals among our peers in Canada. So a lot to fix and a lot to watch in 2026.
And Ontario needs some wins right now. Jeff, thank you as always, sir. Always a pleasure. Happy New Year to you. And we'll see you next week, right?
Yep, see you on Monday.
Wonderful. All right. That was Jeff Hull, Senior Financial Advisor at Manulife Wealth. Coming up, the U.S. is offering Ukraine security guarantees for 15 years as part of a proposed peace plan. But Ukraine's President Volodymyr Zelensky says he'd like to see a commitment of 50 years. More on that next. A high-stakes meeting that could potentially lead to the end of the war between Russia and Ukraine taking place in Florida yesterday between the Ukrainian and U.S. presidents. But as CTV's Kamal Karamali tells us, there's some sticking points that could slow down the process to a peace deal.
This is the meeting that could spell the beginning of the end of the nearly four-year war between Russia and Ukraine.
We covered, somebody would say 95%, I don't know what percent, but we have made a lot of progress on ending that war.
Ukrainian President Volodymyr Zelensky in Florida to try and get U.S. President Donald Trump to sign off on his 20-point peace plan.
Of course, if we will go further, and I hope that really we will have decisions in January.
Those steps involve Russia being a willing participant, which is still in question. One of the key sticking points include territory in eastern Ukraine. Ukraine has said it is willing to withdraw troops if Russia does the same and allow the region to become a demilitarized zone.
That is beneficial both to Ukraine and not to Russia because they don't want to move off of the front lines at all. They want to keep the line right where it is.
Ukraine is also looking for security guarantees, support from other nations should Russia attack again.
Those security guarantees will be provided not only by European and NATO nations, but in the 20-point plan, it specifically spells out the United States. And President Trump has also indicated that the United States is prepared to do that.
Part of the reason why rounding up support from Canada and European leaders was so important before meeting Trump. Although time is of the essence for Ukraine, Trump had this to say before the meeting.
I don't have deadlines. You know what my deadline is? Getting the war ended.
Zelensky claiming Russia doesn't want to negotiate under peaceful terms, pointing to the attack on Kiev earlier this weekend, but Trump maintaining both sides want a peaceful resolution. Kamal Karamali, CTV News, Toronto.
Coming up, Apple has long led Silicon Valley when it comes to tech, but in the world of AI, it's fallen way behind. More on that next. Apple has long led Silicon Valley in tech, but in the world of AI, it's fallen behind. Continued missteps could arguably threaten the iPhone's dominance. What went wrong, and can Apple catch up? This Bloomberg doc takes a look.
We've all been there.
Siri, what's the name of the guy I had a meeting with a couple of months ago at Cafe Grinnell?
You met Zach Wingate at Cafe Grinnell.
Zach!
Actor Bella Ramsey was bailed out by a new version of Apple's Siri that was meant to be available for all.
That feature still has not been released. It's originally supposed to come out April, May of 2025, but now it's on track for spring 2026.
Apple took down the ad and is facing a lawsuit over the delay. But the disconnect exposed a deeper issue. The company was losing ground in the AI race.
They totally missed the boat. There was indecision. There was lack of concern that this could become a real thing.
This is a story about how hard it can be to stay on top.
AI is something that wasn't in their DNA.
Continued failure doesn't just hurt Siri. It could threaten the iPhone's dominance. The product line accounts for more than half of Apple's revenue. So missteps with what's become its most noticeable missing features could be devastating.
AI has the ability to be a make or break moment for the company.
Apple has always been about good design and accessibility.
Historically tends to wait until the technology has been improved by others, then it will perfect it with its own design and some of its own features, and then it will show it to people. And it's done that really well.
They knocked it out of the park with multi-touch, the very core of the iPad. They completely destroyed the competition with their chips. But with AI, they seem pretty far away from really nailing the user experience and the core tech.
Nowhere is this more apparent than with Siri, its character in a play also starring Amazon's Alexa, Google Assistant, and for a while there, Microsoft's Cortana. Poor Cortana. But here's the thing. Apple didn't create Siri. It bought it.
Siri.
Back in 2011, the little-known app gave Apple a head start.
There was really nothing like it on the market at the time.
What is the weather like today?
Here's the forecast for today.
People had been clamoring for some kind of assistance software, and it looked like they had something very cutting edge.
Now this race is far from over.
But its early lead didn't last. Within a few years, those other players hit the stage, and they felt far more advanced.
They came out with a product 4 years after Siri, but it quickly felt that they were 4 years ahead of Siri.
Again, Apple threw some money at this burgeoning AI problem. It poached one of Google's top AI executives, John Giannandrea.
He quickly took over Siri and all the AI initiatives. They brought everything under one roof, and at that point, people were very excited. Not only had Apple taken a prized AI mind from its biggest competitor at the time, but now they felt like they can push all their eggs into the AI basket.
Giannandrea's team tried building a lighter, faster Siri, but the project was ultimately scrapped. Meanwhile, rivals were racing ahead to develop large language models, a foundation of generative AI. For Apple, things were about to go from bad to, "Hey Siri, what's a good word to finish this sentence?"
It's called ChatGPT, the AI language tool that is fascinating and frightening people around the world.
It makes it almost like you're talking to a person.
ChatGPT changed really everything for the world, the industry.
People were experimenting with similar technology to what OpenAI was using, but they hadn't put it together in quite the same way and released it to consumers. Other companies quickly realized, hey, they've really caught on to something here, something that people seem to want.
Craig Federighi, Apple's software engineering chief, he realized this is a game changer. So him and other executives sat down, met with OpenAI, met with Anthropic to get a crash course on LLMs and models. And so Federighi immediately put the software engineering group to work to develop a new system-wide approach to AI.
It's showtime.
Everything converged at the Worldwide Developers Conference in June 2024, where the company revealed Apple Intelligence.
Personal intelligence system that makes your most personal products even more useful and delightful.
Came out and they showed all sorts of features that seemed impressive. One was for summarizing text.
Writing tools can rewrite, proofread, and summarize text for you.
Summarizing notifications.
Make a Genmoji.
They created something called Genmojis, which basically allows you to type in some text and create any type of emoji based on the text input. They also came up with features like notification prioritization. And Apple called this AI for the rest of us.
We are introducing the industry milestone product, Macintosh.
It was a callback to when they introduced the Mac, and they call that the computer for the rest of us.
But Apple Intelligence was a dud out of the gate.
They announced the iPhone 16 that September, and they called it the first iPhone built from the ground up for Apple Intelligence. Truth was a little different. Apple Intelligence didn't launch until a month and a half after the iPhone 16. But the biggest drawback were the AI Siri features.
You know, the ones still missing from the phone.
Apple Intelligence is a huge black eye for Apple. It's one of the biggest issues the company has had in its history.
Investors have taken note.
AI shortcomings are one reason why Apple's share price has performed weakly this year among the so-called Magnificent Seven tech giants.
In a vacuum, the Siri features may not seem super important. The reality is that we're moving into an AI device ecosystem, a world of products driven by machine learning and artificial intelligence. Meta's working on this, Google's working on this, even Apple's former design chief, Johnny Ive, is working on this.
Apple has several projects to rescue Siri: a rebuilt engine, an AI web search tool, a refreshed visual interface, and a more conversational assistant.
They want to make Siri an always-on life co-pilot that can get things done on your behalf and is something you can trust.
The big element under discussion is how much the company will rely on an outside partner versus its foundation models team. What the heck is a foundation model, you might ask? Good question. Essentially, it's a grand jack-of-all-trades software that powers an AI tool. OpenAI's GPT-5, for instance, is the foundation model you can throw anything at via the product ChatGPT. It's the engine of the family car. And for Apple, this technology could form the core of a new, more capable Siri.
Apple has talked with Google, with OpenAI, with Anthropic, about replacing their foundation models with the underpinnings from those third parties. If Apple's able to do that, you're looking at a really potentially great product. Marrying Apple's user interface design with the hot core technology, that would go a long way for consumers. Because consumers, for the most part, don't really understand or care, quite frankly, who made the AI technology, and Apple just wants to sell cool products.
What they're hitting up against here is with generative AI, it's so expensive and so time-consuming and difficult to build this kind of thing yourself.
Ironically, some of the company's notable practices have hindered its own progress. First, spending. Despite having a lot of cash on hand, Apple doesn't do it lightly.
In the AI world, you're investing tens of billions of dollars a quarter, depending on what your company is, without even knowing if you're going to get a payoff. Apple doesn't invest large sums of money without knowing there's going to be a gigantic payoff.
This chart reflects the trend. Amazon, Google, Microsoft, and Meta are pouring billions into chips and data centers to power their AI models and support a business model of providing AI services to others. Apple's expenditures are far less, in part because it's only ever focused on building for itself.
With Apple Intelligence, powerful intelligence goes hand in hand with powerful privacy.
The company's stance on privacy also creates limits. It's championed on-device AI, processing much of your data locally to keep things private. But the iPhone's processing power only allows for simple features like summarizing an email. For more advanced requests, Apple turns to its own so-called private cloud compute servers, which use its own model and chips, or on occasion, ChatGPT.
Take a look at how many iPhones it sold, 3 billion. They could have had access to so much search data, how people are using their phones, what apps they're using, but they really haven't used a lot of that to do training.
That same caution extends to its product development.
When Apple wants to develop a product, it does its research and it sits down to build it, and it knows exactly what it's going to build and how it's going to get there. AI is more of a universe where you're figuring out things as you go along.
In the past, where you might release a new product or do a software update once a year, perhaps twice a year, this seems to be like a constant churn, and it's really hard to keep up, even if you are a large company with a ton of money.
On top of this all, competitors are trying to lure top talent in the field, much like Apple did a few years back.
Meta and OpenAI are throwing large sums of money at Apple's foundation models engineers to get them to jump ship. In one case, one leader of Apple's foundation models team, Meta offered him a pay package over several years worth well north of $200 million.
In tech, you might be paid a lot as an engineer, but that would tend to be in like the hundreds of thousands of dollars, perhaps. This is just pushing things into a whole new stratosphere.
Good morning. Welcome to Apple Park.
At the iPhone 17 launch event in September, Apple had little to say about AI.
Design has always been fundamental to who we are and what we do.
But behind closed doors, Cook has described the AI revolution as big or bigger as the internet and smartphones, and told staff succeeding is, quote, ours to grab. Alongside a new Siri, the company is developing a bunch of products to help it catch up.
We saw this for many decades. Nokia was at the very top of the phone industry. Apple came out with a much better mousetrap. BlackBerry was at the top of the industry. Apple came out with a better mousetrap. They are going to be in danger of the next Apple being created if they don't get their act together soon with some serious acquisitions, changes, and partnerships.
Up next, commodities are strong and central banks hint at mild rate cuts. What does that mean for your portfolio? We'll have more next. Silver sliding today after topping $80 US an ounce for the first time ever in overnight trading. The precious metal is still higher by more than 155% for the year. Started 2025 at a little more than 20 US. Silver is viewed as a safe haven for investors wary of heightened geopolitical tensions and other risks like the ballooning US deficit. Lululemon founder Chip Wilson is pushing for a board shakeup while Lululemon searches for a new CEO. Earlier this month, the company announced Calvin McDonald would be stepping down in January. Now, Wilson has nominated 3 candidates for Lululemon's board, including former On Running co-CEO Mark Moore, former ESPN Chief Marketing Officer Laura Gentili, and former Activision CEO Eric Hirschberg. The United States is offering Ukraine security guarantees for a period of 15 years as part of a proposed peace plan, Ukrainian President Volodymyr Zelensky saying on Monday. Despite the offer, the Ukrainian president has said he would prefer an American commitment of up to 50 years to deter Russia from further attempts to seize its neighbor's land by force. SoftBank Group has agreed to acquire Digital Bridge, a U.S.-listed investment firm focused on digital infrastructure, including data centers. The Japanese conglomerate will pay $16 U.S. per share in cash for Digital Bridge. The acquisition is part of SoftBank's push to invest in the digital infrastructure fueling the artificial intelligence boom. Taking a look at the markets, bit of a soft day for the TSX. Again, it's off by 0.14%, following another drop to end last week, that shortened day. It's also a slow trading time right now. And in the U.S., similar situation. Everybody is in the red right now. S&P 500 off by 0.4, the Dow by 0.46, and the NASDAQ off by 0.6%. Even with those numbers, as we head into 2026, the outlook is fairly upbeat for a lot of people. Commodities are showing strength. Central banks are signaling only small rate cuts, pointing to a soft landing for the economy. So what does this mean for your portfolio? Let's break it down with Sid Mokhtari, Chief Market Technician at CIBC Capital Markets. Sid, thanks as always for joining us.
Thanks for having me.
Okay, let's before we look ahead, let's look back quickly. TSX performance for the year. What do you think? How did it compare to the U.S.? What are we going to see when when the clock turns on 2026?
I think the bias for us is a little bit more friendly toward the TSX index. There's a value tilt for the benchmark index that we have here relative to the U.S. We are seeing even in the U.S. there's a bit of a preference for the value factor as we go forward. So having Canada exposure, in our opinion, for the next little while is better. We also looked at some of the metrics, CAPE ratio, how rich Canada is relative to the U.S. We're not at extreme levels as U.S. is. So we do have that preference for Canada over the U.S.
And what do you like about the value tilt? What do you like about it with Canada?
I mean, we do have an energy sector that is still perceived to be a value space. Hasn't really done much in terms of performance relative to other sectors or the benchmark index. So I think there is opportunity in that space. We favor natural gas from that complex. We're also seeing good parts of industrial base metals that are showing a stronger backdrop from a price performance as well as relative performance against some of the other sectors that are emerging. So I think we've liked gold and silver, but to be fair, they've been very strong, and it's reasonable to say that bulk of the seasonal factors for the precious metal space, they tend to subside as you go past the month of January. But on the back of after that, we find better price performance coming from the base metal. So if I had to say, do I like aluminum, zinc, nickel, copper, relative to precious metal, I would say yes. I think base metals are better from a value perspective, and they are also cyclically better tilted if there's an economic growth trajectory continuation.
Any indicators what's fueling that or what's driving that for you?
For us, at least for the time being, copper, it's not so much about demand, it's more about supply. But it's fair to say that, if we assume, the robotics and EV adoption, as well as, technology in general, I think electrification, which is tied to copper space, even silver, it's reasonable to say that, we want to favor that space. And we are seeing a lot of good technical breakouts. Quant factors of ours at CIBC are also, favoring this space. So it's reasonable to say that we do want to, like the coppers and zincs and nickel and aluminiums of the world.
And what kind of a factor are gold and silver going to be, do you think?
Believe it or not, I mean, gold has been more of a GARP factor in our models. Similar with silver. They've also been very much tied to the momentum factors. And I would say beta and GARP are likely to rest as we go forward. And like I said, I do think we have a cyclical tailwinds that is probably going to favor some of these industrial-based metals as we go forward.
Okay, taking a look at other sectors, financials, how are you expecting some of the other sectors to do?
I think they've done a great job, and I generally think there's nothing, to be said poorly about the sector, other than they are very deeply overbought by every mean reversion assumption. A measured move naturally would be a reversion to a, call it, quarterly moving average or a 10-week average, and that's about 5 to 7%, in some cases 9% for the financial gig sector. So that's the risk that we see. In fact, in general, we do think 2026 is a year that is a year of cycles, if I may say so. It's year 2 of the U.S. presidential cycle, which is the weakest year in the cycle. It's also a year 4 in a 4-year bull cycle. We've had 3 years of strong double-digit returns for the broad benchmark indices, and the law of numbers historically, they do show that it's not that often to see a continuation as such from the performance perspective. Nevertheless, we do think best performance from a year 4 and year 2 of a presidential cycle and a year 4 of a bull market, it's usually back and loaded. So we assume maybe H1 is more about consolidation, and H2 is more about resumption of the bull.
Okay, so a softer year kind of looking ahead. Rates. You're saying the U.S. Fed, Bank of Canada, looks like they may a restrained path of rate cuts. I mean, we've heard that the Bank of Canada, we may not see any cuts this year, or maybe possibly even a hike by the end of it. In the U.S. Fed, we've had talk of 2, maybe 3. Where do you see them going?
We generally think that we're looking at the most, call it, range-bound structure for the rates for the 10-year U.S. We are looking at 440, 450 on the upside. Downside, we're looking at 4%, 380 downside, and we peg Canada the same way. We would say that we're dealing with a range-bound rate market, at least from our perspective, and that's probably going to be a good thing. It's probably going to be able to keep equities and other risk assets better buoyed as we go forward. But nevertheless, I would say rates are very boringly range bound, to be fair with you.
Okay, well, we'll leave it there, Sid. Thank you as always for joining us. Have a great new year.
And you as well. Thank you.
Sid Mokhtari is Chief Market Technician at CIBC Capital Markets. Up next, we are unpacking a 2026 outlook for precious metals, including gold and silver. That's after the break. Silver retreating sharply today after smashing through $80 an ounce for the first time, halting its record-breaking rally. You can see it's down by 7.75% right now. Gold also falling along with it after its record-breaking year. For more on this and what's in store for the metals in 2026, let's bring in John Ng, President and CEO of Maison Placement. John, thank you as always for joining us.
Good to be here, Roger.
I mean, it's already been quite the year, and what a way to finish it. I know we want to talk about gold, but can we just touch on the silver a little bit? Your thoughts on what's unfolding with that?
Well, silver and gold have been displayed this year phenomenal bubble-like characteristics, and the consensus and a lot of mainstream view is that, oh, it's a bubble. While it's performed bubble-like, I think that you have to look at the fundamentals. Now, for silver, it's a little different. There's definitely some speculation there, and it's a classic short squeeze. We've been here before, Roger. I mean, in 1980, there was the Hunt brothers squeeze. And what happened, very similarly, back then was that this time the CME introduced a $25,000 per contract on the near March contract. And what that means, it makes very expensive to hold a contract. When you look at, just to back up, the fundamentally is gold and silver and a lot of commodities are traded in the derivative markets. And for some time, there has been an issuance of short contracts, people who expect the silver market to go down. And in fact, there's something, a short position of about 250 million ounces. Now, that seems a lot, but when you look at the supply of silver, it's something like 800 million ounces. But the demand is 1.1 billion ounces. So, and then you would superimpose on that the derivatives, and this is what's happened is that there's a big short position. So just at year end, the Federal Reserve held an emergency meeting and imposed, and not imposed, but put in $17 billion into the repo market. This is the Fed's financial plumbing. And you have to wonder why. Well, the big banks are exposed because a lot of them have the short position in silver and, in fact, in gold. And they have made, for the last decade, lots and lots of money. And they have been behind the short position. Now, they say they're supporting their commodity operations. But you see big banks like JP Morgan, HSBC. In Canada, you have Scotiabank that have believed to have been bailed out by the repo market. So when the CME, coincidentally, put up the margin, it became very difficult to hold positions. Therein, you had the 7% correction today in the silver market. And of course, there was an overflow. Gold fell something like 3%. The point is, however, and then I think a lot of people tend to forget, is the big kahuna in all these markets are China. China provides something like 65% of the silver market, and they are big producers, both of silver, but also of gold. In fact, they are the largest producer in gold. So as far as China is concerned, what China did, and a lot of people missed it, was that China said, well, we might put some limits on the silver exports for 2026. And this stems back way to the tariff war and the expectations that the Americans have imposed tariffs on everybody, including China. But they have backed down on China and other countries such as Brazil. Canada, of course, we're out in the left field. But nonetheless, China has said to the world, well, not so fast with these tariffs. So that has been another factor. So all this has happened, I'll finish. All this has happened at a time when silver producers are trying to produce silver, but also silver is produced as industrial metal. And that presents problems on the supply side.
So where does this leave gold and silver heading into 2026? And I mean, tech Solar power is a huge user of silver. Does this put pressure on those companies as well?
Well, mining game, Roger, has become the great new business now. It's, in my opinion, it's going to be better than the artificial intelligence. We have finally realized the importance of mining, in particular to a country like Canada, and that we have to boost reserves, and we have to boost mining to get those reserves out of the ground. Critical minerals are very important. Silver, we're using a lot of. Gold, however, is a monetary metal. And when we have tariffs, that presents problems. But fundamentally, is the geopolitically, the world has missed that the central banks are now buying gold as an alternative to the dollar. Therefore, there is literally a shortage of gold, and because gold is become an alternative to the dollar and the monetary metal. So my expectation is that these prices are going to go much higher in 2026, and we'll be surprised. So it's not a bubble. I think the best lies ahead.
All right, we'll have to leave it there. John, but thanks as always for joining us. All the best for the new year.
And to you.
John Ing is president and CEO of Maison Placement. Well, if there was one word to define 2025, it would be tariffs. We'll dive into the 2025 tariff story right after this. Well, one word that really helped define 2025 was tariffs. CTV's Mike Couture has more on the threats and taunts over tariffs that took over 2025 and triggered a trade war.
We don't need their cars, and we don't need the other products. We don't need their milk.
It was the opening salvo in the year-long trade war. Threatening to take Canada by economic force, President Donald Trump floated punishing tariffs on his first day in office.
We're thinking in terms of 25% on Mexico and Canada because they're allowing vast numbers of people. Canada's a very bad abuser also. Vast numbers of people to come in and fentanyl to come in.
They applied to all goods not covered by CUSMA. The day they took effect, Canada hit back.
Tonight, I am announcing Canada will be responding to the U.S. trade action with 25% tariffs against $155 billion worth of American goods.
Provinces also joined in the fight, removing American alcohol from liquor stores and threatening to cut off energy exports to the U.S.
The next Prime Minister of Canada, Mark Carney.
After campaigning on going elbows up in the face of Trump's tariffs, Prime Minister Mark Carney went to D.C. a week after the election, looking to reset the relationship. In that Oval Office meeting, the Prime Minister did push back on talk of Canada becoming the 51st state.
As you know from real estate, there are some places that are never for sale. And having met with the owners of Canada over the course of the campaign last several months, it's not for sale, won't be for sale.
The two met again at the G7 in Kananaskis, where they reportedly set a 30-day timeline to get a deal done. But the pathway remained the problem.
I've always been a tariff. It's simple, it's easy, it's precise, and it just goes very quickly. And I think Mark has a more complex idea, but also very good.
Over the summer, Canada responded to Trump's complaint about the digital services tax by removing it. While talks continued, so did the threats and uncertainty for businesses.
You guys are about as dumb as a bag of hammers for doing this.
And when the company that makes Crown Royal whiskey moved work at a bottling plant from Ontario to the U.S., Premier Ford didn't hold back.
So this is what I think about Crown Royal. That's what they could do. And I think everyone else should do the same thing.
With trade talks slowing, another Oval Office meeting took place in October, where Trump spoke glowingly of Carney and Canada.
I would think he's more popular now. He's a good man. He does a great job, and he's a tough negotiator.
So then what's holding things up? If he's a great man and you want to do a deal with Canada, why aren't you?
Because I want to be a great man, too.
But that laughter would fade after Ontario released an anti-tariff ad in the U.S., using a speech by former President Ronald Reagan. Trump called it a hostile act, while his ambassador to Canada described it as election interference.
A foreign government running political ads in the United States during election season
is unprecedented.
Carney would apologize to Trump at the APEC summit, and weeks later, the prime minister downplayed how much or little he communicates with Trump.
Who cares? I mean, it's a detail. It's a detail. I spoke to him. I'll speak to him again when it matters.
Those words got this response from conservative leader Pierre Poilievre.
All of us on this side of the House care about the communities that are being emptied out in our forestry, the steel workers in Hamilton who don't have jobs to pay their mortgages. We care.
Carney, Trump, and Sheinbaum had a 45-minute meeting after the FIFA World Cup draw. In the same week that Trump mused about letting CUSMA expire, he also agreed to keep working on the trade agreement.
Canada makes a lot of things that we don't need because we make them also. But we'll work it out.
The following week, Canada's envoy to D.C. announced she would be stepping down in the new year, saying it was time.
Our discussions with the United States with the CUSMA review, the Canada-U.S.-Mexico Trade Agreement review, that's going to start up in the new year. And I think it's important that we have someone in place that is going to be here through the conclusion of those discussions.
The formal joint review of CUSMA is scheduled for July 1st, 2026, setting up what could be another year of turmoil with our largest trading partner. Mike Lecouteur, CTV News, Ottawa.
Market Call is coming up next. Today on the show, we have Brianne Gardner. She is Senior Wealth Manager from Velocity Investment Partners, Raymond James, and we'll be taking your questions on Canadian and U.S. large caps. Thanks for watching Morning Markets. I'm Roger Peterson. We'll see you back here tomorrow.